Hello, everyone. Today on The Final Bar, I'll be talking with David Cox from Raymond James, coming to us from Ontario. We'll talk about some of the charts that are top of mind for him, looking at different areas of the U.S. markets, how they relate to the overall trends that we've seen year to date in 2023. Arguably, trends that have been working continue to work, but on a day like today, some cyclical sectors, some value-oriented sectors moving to the top of the list: financials, materials, and energy. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit is really designed to help you understand the market by quantifying investor psychology. That's how I've always thought of it. I don't like to think of charts as representing just numbers or pixels on the screen. They represent investors. They represent traders making decisions and aggregating all those decisions, all those buy and sell decisions into trends and into price movements. And there is information embedded in price. Charts allow you to really, I would argue, have a conversation with the markets and see what you can see. Focus on what's happening, improve your awareness, your market awareness of what's going on. Now, we think of a day like today, major averages sort of mixed. The NASDAQ flat, the S&P up a little bit, but overall, some of the beaten down sectors, some of the underperforming sectors like financials and materials having a pretty decent day. Is this the beginning of a raging recovery for financials? I don't know if I could say that just yet, but you are seeing some signs of life in charts like JP Morgan, maybe starting to break out. We'll look at all those charts and more here as we start our market recap. As always, we have polls going on our social media platforms, on our YouTube channel, of course. So make sure you subscribe to our YouTube channel, of course. But one of the recent questions we asked you was this one: what market environment do you find the most challenging and why? Three choices: a bull market, a bear market, or a sideways market. I will be completely honest with you. My main goal with this question was to remind everyone that there are indeed three directions. So when I'm often asked, are you bullish or bearish on blah? And it doesn't matter what the blah is. I always have to remind people there are three ways that this thing can go. And that third one, the sideways market, I would agree with the 60% of you that answered sideways market is the most frustrating, because I would agree, right? Whether or not you have a long position, a short position, whatever your position is, a sideways market pretty much frustrates everyone, except unless you have some straddle or a strategy and options play that allows you to play on a volatility or play on the market staying in a particular range. But for the average plain vanilla equity and ETF investor, sideways markets can be super frustrating. The reality is they don't last forever, and that's why I find when a market is moving sideways, what we call a basing pattern, it's all about defining that pattern and then recognizing when the picture changes. And I think that's why it's important to recognize the boundaries of those patterns, identify and anticipate when you see a break, and then understanding that movement into momentum, that change of character that is telling you something is new. So I would agree with you. The good news is charts are the ideal way, I would argue, to recognize that a sideways market is playing out and recognizing when that picture may be changing. Let's get to the market recap and see what's actually played out through the course of the trading day today. The S&P 500 finished just below 4,400, just a hair's breadth away from that sort of big round number, up about 0.5%. So not a bad day by any stretch, but not really pushing through to new highs just yet for the year. Sort of still bouncing off of support around 4,300, still progressing to the upside. So a lot to be excited about in terms of the continued trend. And again, our market trend model, as we highlighted yesterday, remains bullish on all three timeframes. That'll change at some point. It's not changing today. The Dow outperformed the S&P today. The NASDAQ underperformed, actually ended up flat for the day. The NASDAQ 100 really focusing on those mega cap growth stocks, down just a slight amount, about 0.2%. Mid caps and especially small caps having a very strong day today. The S&P 600 small cap index up 1.7%. Volatility pushing back up, but not by much, right? The VIX is still relatively low compared to the last 12 to 18 months, amazingly low. And even compared to 2021, we're at a lower level of the VIX than we were for most of that year. So VIX in the low teens as the market's going higher means, in my analysis, that we are in a slow and steady uptrend, kind of that grinding higher environment. At some point that changes, right? At some point the uptrend breaks because charts that have been going up stop going up. They stop making new highs, they start making new lows. That really, broadly speaking, is not happening a ton, particularly in the leadership stocks that we would want to identify. And volatility would start to increase. That would be a likely change from this low volatility rally that we've seen. For now, it's telling you more of the same. Market continues to be in a fairly healthy stage on low volatility. Interest rates overall moving higher. The short end of the curve, not much of a change. The middle and longer end of the curve really pushing to the upside a little bit. 10-year yields finishing the day around 385. The 5-year yield well above 4% now around 4.14. So, look for those rates going higher. That's a bit of a change. The TLT, which is the bond price ETF, it's a long treasury ETF, down almost 2%. Still very range bound, but sort of rotating to the lower end of the range that it's been in for quite some time. Continuing on, the dollar up a bit, about 0.4% for the UUP. In terms of commodities, not a ton of change. Broadly speaking, the DBC flat for the day. Gold just a little bit below zero, but not much change. Silver prices continuing to struggle, and you've seen silver underperforming gold here recently. Both of those charts, I would argue, kind of broken in terms of a strong uptrend. Gold and gold stocks had been one of the stronger areas of the market not too long ago, but now very much changing and rotating lower. That shift, if you're looking for what a rotation, what a change of character could look like, I would look at the chart of the GDX or something like that, and you'll see a position of strength rotating to more a position of relative weakness. Oil prices moving up a bit today, and energy, as I mentioned, having a decent update along with some of the other value-oriented sectors. Cryptocurrencies continue to push in the green, and you see Bitcoin just above 30,600, Ether just above 1850. Both of those up about 1.6 to 1.8%. We had a great conversation yesterday with Adrian Zadunchik. If you missed that, it was a really good conversation about some of the trends and the long-term picture in Bitcoin and other cryptocurrencies. I'd encourage you to check that out if you missed that conversation. Finally, when we look at the 11 S&P sectors, as I mentioned, the leadership that we've been talking about is all at the bottom of the list, or many of them are at the bottom of the list today. The XLC, the worst performing sector, down 0.6%. There are a couple sectors that actually had a really decent update. The financial sector, materials, and energy. Financials were up 1.7%. Now, one of the sectors we've not talked a ton about, particularly at the top of the leaderboard, is the financial sector. The average chart in the financial sector, not particularly strong, especially on a relative basis when you compare it to the strength and the resilient uptrends that you've seen in some of the growth sectors. The financials, materials, energy, very much underperforming. But a day like today, a bit of a mean reversion, those beaten down sectors starting to rally. Rotation into those sectors has days like this, but then more and more of them, right? You start to see more and more where there's a give back from some of the previous leadership and a rotation into some new leadership. I think it's a little too early to say that move is a broader move for today. It's certainly a contrarian move from some of the trends that we've been observing through the course of 2023. Let's go to a chart of the S&P 500, just kind of check in on what happened today and how that relates to the trends as we look over time. So the story of the S&P 500 in June is the beginning of June was really a breakout period, right? Breaking above 4,200, that was getting above the February 2023 high. Significant breakout. The next upside objective in our work was 43.25. That's the August 2022 high. Also represents a key Fibonacci level. It's a 61.8% retracement of the way back up from the October 2022 low to the January 2022 high back off the left side of the chart here. After breaking above 4,300 a couple weeks into the month of June, we pulled back. And in a classic technical sort of phenomenon, you have the breakout and then you pull back and retest that breakout level, right? That resistance becomes support. And for now, what we've seen this week, this was Friday going into the close. All of a sudden we rally, and the last couple of days have actually putting back to the upside. You're seeing some closes above the opens. You're seeing another day, again, not dramatic, huge up days, but nice sort of a nice bounce period off of those lows. I mentioned many times in an environment when the trend is up, and I think if you look at the S&P, the Qs, the Apple, or any of those leading names that have had really good runs, as a trend follower, I think it's important to use some sort of methodology, if not a series of tools, to define that trend and then recognize when that trend is no longer in place. And a lot of times what I like to do is use what I call a line in the sand approach. What's that level that as long as we stay above it for now, the trend is positive? And when we break that level, you sort of agree to yourself, I'm going to revisit this position, this thesis, and just admit that something might be different. 4,300 is kind of that level for me, this week and this month. And I think as long as we hold above 4,300, we continue to make some rotation to the upside. This is a very strong trend that continues. We break a level like 4,300. That's when I think a question mark is all of a sudden put on that bullish face, at least in the short term, telling you there's a bit of a tactical drop down. Now below there, because of the nature of the rally, there are a lot of potential support levels where a drawdown could actually end up if we would get it. But for today, I think you're seeing further upside. And again, some of those leading stocks, leading charts continue to look particularly strong. Now, the leadership, as I would define it in 2023, in a lot of ways, what we call the phenomena stocks, those 8 names that really capture that mega cap growth trade in 3 particular sectors: technology, communication services, consumer discretionary. What's interesting is on a day like today, if you wonder why the NASDAQ's struggling, if you wonder why the benchmarks, major benchmarks are not doing any better on a day like today, having these 8 stocks handy and just looking at the movements, that'll tell you a lot about what happened through the course of the day. Because if these stocks are working, our major benchmarks are overall probably doing just fine. When they start to struggle, that's when these names can look, or that's when the markets will struggle as well. Even if all the other names are up, these 8 stocks represent a huge proportion, a huge percentage of the S&P, and it would be unlikely that they would do very poorly and the rest of the market would do very well. But in that condition, I think the major benchmarks would probably be more flat than anything because there's such big names that would be a huge weight on the S&P. What's interesting is if you look at those 8 particular stocks and you think about them, there are some different patterns kind of emerging. And I think Apple for now is sort of the best example of this relentless uptrend. It just continues to, Charles Dow style, keep making a higher high and higher low. And in some ways, I would say these are some of the easiest charts to analyze because at some point, we stop making higher highs and we stop making higher lows. That happens. It's not happening today. Today, we're continuing to make new 52-week highs, and that means the trend is still positive. Get concerned when that no longer happens. Get concerned when you see a bearish momentum divergence, and we're not seeing that yet either. We're seeing continued uptrend on strong momentum. Now, charts like Meta, I would say, kind of in a similar pattern. They're continuing to push higher. Is this a bit of a divergence? It's not an ideal one because I would say the ideal divergence would be overbought the first time and not overbought the second time. But I am noting we're getting less excitingly strong momentum as the market's going hard. But overall, we're still making higher highs as well. Amazon making new highs as well, but I think this might be an important one to watch. I mentioned Apple not doing a bearish divergence. I would argue this might be what we're seeing here. I think it would be a little more clear if Amazon would come off a little bit, maybe going into the holiday weekend. But for the month of June, you're seeing higher highs in price and weaker momentum. It could be a bit of a concern, to be honest with you. So that's one to pay attention to. Now compare those 3 charts with based on price alone are just continuing to push higher. Compare that to some of the other ones in that sort of phenomena bucket, right? You have a chart like Adobe that's gapped higher and never really gotten above that gap period from a couple weeks ago. What else might make sense to look at? Oh yeah, maybe like a Netflix would be the next one to go to. This one kind of similar, right? Where you're still making higher highs, but instead of making a new high today, we kind of recently pulled back. Reminds me maybe of the chart of AMD a little bit, which is sort of having a nice rally and then a recent short-term pullback. But some of these, again, some of them looking stronger than others. NVIDIA continuing to make new highs, higher highs and higher lows. So in these leadership names, again, I think defining the trend and then tracking that trend as long as it continues can be pretty important. Just to finish off our market recap, financials, the best performing sector, up 1.7% today. This is the XLF that we're looking at. Worth noting, the XLF today closing above the 200-day moving average. It's actually attempted to get above the 200-day a couple times in the last quarter, and it's failed in every one of those previous attempts. Is this time different? Is this enough of upside momentum? And look at the XLF. It's had these breakouts and retests from above there at the end of last year, a breakdown and a retest from below at the beginning of the second quarter. Is this now the final rotation as we make a higher low and this propels us to a new swing high? Maybe. And I would say the average financial stock still looking a little bit tough. We were Grayson Rose and I were actually talking next week on Monday and Tuesday. We're going to do a special 2-day presentation or two-part video on the top 10 stocks to watch in July of 2023. As a bit of a foreshadowing, JP Morgan may come up in the conversation because I think this is a sector that a lot of people have forgotten, and this is a key resistance level right around 140 to 145, kind of bumping up resistance yet again. This is a basing pattern that's been playing out for the last 6 months or so. So while financials are improving today, it's not quite enough to get really exciting just yet, particularly on a relative basis. Is this the beginning of a big breakout for JP Morgan? Maybe, but I don't think enough of a follow through just yet. But I think it could be an important chart to pay attention to. Materials also up as well. And again, the challenge with materials, I think it's still sort of in a basing pattern really since November of last year. You see the rally off of the September and October lows sort of pushed higher toward the end of or the beginning of December. From there, we've sort of been sideways. You can draw a big rectangle over this price action. It's been underperforming because, again, the growth sectors have been working particularly well. But in materials, you have some stocks that are actually showing some new strength. Reliance, RS is a name that comes to mind. There's a couple steel names, which is one of the better scoring group. Nucor has actually rotated back above moving average support, now testing highs from previously over the last year and a half. So there may be the beginning of something here, but I would encourage you, if you're looking at these sort of stocks and these sort of sectors, sort of define what levels, what signals you would need to see to turn more optimistic and see that it might deserve a position in your portfolio. That's a wrap for our market recap. Thanks for checking that one out. I'm going to come back here momentarily with David Cox of Raymond James. But first, I want to remind you, we are doing a mailbag on Friday's show tomorrow. We'd love to feature one of your questions on the air. Easiest way to get your questions to us is via email, thefinalbar@stockcharts.com. That's the best way to get your questions to us. As a reminder, take a permalink below the chart that you're using on StockCharts. I can actually then see a live version of the chart you're asking about. On Twitter, just tag us in a comment @FinalBarSCTV. And on our YouTube channel, which hopefully you're watching now, just put a comment right below the video that you're watching. Again, we'd love to hear from you, get your feedback, get your opinions, but especially your questions for our mailbag. And we'll do another mailbag on Friday's show of this week. I want to welcome on today's guest, David Cox. David's a portfolio manager at Raymond James, coming to us from the Toronto area, generally speaking, around in Ontario. David, it is so good to see you. I saw you recently at the CMT Symposium in New York. How are you these days, okay?
Yeah, no, I'm great, thanks. And it was great to get down to New York. I had traveled out of the country in a few years, and it's good to see you.
It was good to do it again, and I think getting that community, that technical analysis community together was a lot of fun. You and I chatted on the floor of the New York Stock Exchange, which is a fun sentence to be able to say to another human being. So it's great to see you again, and thanks for coming on the show here. Have a couple charts that you shared with us, and I really want to get into some of the patterns and some of the things that you're seeing. Your first chart is looking at stage 2 uptrends with the S&P. Can you share us what this means and what it's telling you here today?
Yeah, for sure. So out of all the things we need to do as investors, we need to understand how many stocks are doing well. And I think moving average crossovers are one thing, but stage 2 comes from the concept of Stan Weinstein and kind of this concept of looking at how many stocks are, just to define it, how many stocks are over the 200-day average, the 150 over the 200, and the 200 is rising. So that's a little bit more I think, specific than a lot of people look at for 200-day averages. And so again, how many percentage stocks of the S&P 500 are in stage 2? And you can see here, we're at about 46.5%. And I've drawn a horizontal line at 30%. And I think if you take a look and you do stand back and look at enough data, you'll see that a recovery out of a very weak, market environment, bear market, what have you, again, starting to see that recovery above 30% is a very positive thing. You can see we did come above 30 earlier this year and then kind of gave it back. But again, things look very constructive. So more and more stocks are participating. It's exactly what we want to see. So to me, it's just another kind of breadth measure, but
all right, Dave, let's stick on this theme of breadth. Another chart you have is really looking at the strength of markets in terms of the stocks making new highs. What is this telling you? Encouraging or less so?
Yeah, no, definitely encouraging. I mean, anytime we're seeing more stocks hitting highs, that's great, and fewer stocks hitting lows. But this chart is just showing again we're starting to see more and more stocks going up to 52-week highs, and that's exactly what an investor should want to see. So to me, in the last kind of month and a half here, what we're seeing is a expansion. And that is what we want to see if we're going to want to continue to believe in this bull market, which is what I believe it is.
It's so interesting because I think a lot of the skepticism, and certainly by me and others through the course of this uptrend, has been narrow leadership Why is it so important that we see the breadth conditions improve going forward here?
Well, I think it's just always important as a market. I mean, we don't want sort of one stock, two stocks, and so forth. And there's a lot of stocks. I think one of the things I've seen this year a lot is that a lot of people have harped on, there's only 5 or 6 stocks that are driving it. But if you actually look, there's been a lot of large cap participation here, and there's a lot of stocks that have been on the move. And that's exactly what essentially this is representing. But each day I've been taking a look at how many large cap stocks out of the universe are making highs versus lows. And today again, 61 highs and 2 lows. I mean, that's just a lot more highs. And so that's expanded a lot into the double digits. And that's exactly what the market wants to see, because that allows other investors to start to come in and start to participate and feel better, right?
I was going to say, for a while, it's felt like a bull market that unless you were in a certain number of names, it probably felt a lot less exciting. Now you're starting to see those breadth conditions improve over time. Let's talk a little bit about small caps. I think one of the big concerns has been a lack of participation in small caps, sort of like mega caps and then everything else. Are we seeing a shift of sorts there?
Well, again, I think it's probably premature, but the small caps and mid caps, I mean, they've been massively underperforming, right? It's been a large cap, mega cap story. But I think what's happened here this month, I think is interesting. And I think we had a bit of a base breakout there in the green circle on the small caps themselves, kind of chopping around there for a few months and then kind of breaking out. And that came out on volume, and that's very good. And then we had a standard looking retest the breakout, and I like it. So retesting the breakout at the same kind of area as the S&P, but we're starting to see some outperformance here, and I like that. Today is another good example. You're starting to see buyers come into this area, and I think risk reward is pretty favorable, but let's stand back. We can see that's not an uptrend. So there's work to do. But I think we're at that point where, again, this is the chance. The small caps have a chance. The mid caps have a chance. Whether they'll go and run with it or not remains to be seen, but I do like the action recently.
Can we talk about the momentum at the bottom? Because it's interesting. I feel like with the large cap space, it feels like the market's overbought. I mean, when you talk about Apple, it's hard to not use an adjective like overextended, but small caps, very unlike that, right? Very different picture.
Yeah, absolutely. So I'm an RSI 5 kind of guy, and that's a little shorter than most technicians, and that's fine. That's just the way I like it. It provides the frequency of signals that I like. But you can see there, when we get oversold, the way I look at charts, I certainly don't want to be kind of getting negative after something's RSI 5 oversold, because the reality is those are the opportunities that if someone's interested in something, we need to be ready to stand in. And so that's an example. I throw a green arrow up there. We're oversold. We've just pulled back. I like the horizontal line. That to me is an opportunity to buy. That is a buy the pullback. And that is exactly how I like to operate, as opposed to going and getting negative after, of course, some kind of short-term weakness, which is prone to whipsawing.
That is a decent pitch for the 5-day RSI, David. Noted. That's one I don't use often, but now the wheels are turning as you're explaining it. Let's talk a little bit about offense versus defense. We've had a couple sectors that have really dominated on a relative basis. You have a really interesting custom sort of setup here showing this relationship. Can you talk us through what this is saying, what it means to you in terms of your overall point of view?
Yeah, for sure. So probably too many lines here, but we've got absolute charts on the top of both sides. Okay, so it's technology times like multiplied by discretionary, and on the right side, utility staples. So again, the offensive flavor and the defensive flavor. So those are 8 and 20 period EMAs in red on both, and then it's a 50 period SMA on the in green average. But the bottom line is, like any chart, I mean, I'm going to look for higher highs, higher lows. I'm also going to go and look at those kind of moving averages turning up, and you can see on the left side, just technology discretionary. It has that move, has that consolidation, and then turns up again in the second circle. That's exactly what you want to see. If you go to the lower panel, you can see those sectors have been clearly outperforming the S&P, which is great. That means they're leading. So we've got absolute uptrends, we've got relative uptrends, and we've got the absolute opposite on the other side. So we've got a choppy mess. Utility staples, I mean, utilities have been super weak. They've both been weak. But I think most importantly, if you look even in the context of the last several days, as you've had a market pullback, there's been no movement at all. Like, take a look at those relative lines in the bottom. The defensive stocks absolutely did not pick up any slack. In fact, yesterday, for example, staples were weak. So again, that's exactly, it's a market that's acting very bullishly, in my opinion. And so I think these charts, I always want to look at them. You want absolutes and relatives, because in an ideal world, you can have both working for you. You're better off.
I'd love to ask you a question we received in the mailbag recently, because it's sort of related to what we just talked about. And with your experience in the financial advisory space. I feel like when interest rates are incredibly low, going to something like utilities, something like staples with a higher yield component makes a ton of sense, right? There's a clear opportunity to gain income that it's tough to get elsewhere. Now, all of a sudden, when we're getting 4 or 5% in a savings account, are those defensive areas of the market as attractive? Is it still meaningful? And why or why not in your perspective?
Yeah, I mean, I don't think they are. I think that's the whole point. I think price has to come down because yield compared to your T-bills or and up here we got GICs. When you can get the risk-free rate, again, government risk, but risk-free rate is the same as the yield on some of these securities. What's the point? You can't go and take on market risk if you're not being paid for it. And I think price has to come down. So if you look at the key, the dividend stock, the biggest dividend payers in Toronto have been very, very weak compared to the market. And in the US, I think the DVY has been underperforming the US here quite consistently. And that's exactly what I think should happen. Of course, we've all got to judge where do rates go from here. But the bottom line is, I don't think it's just some layup to try to go and hang out in a space and try to be defensive. Underperforming absolutely and relatively, like that's not what you want.
Yeah, I feel like that income component of some of those income-oriented sectors a little less attractive, if not a lot less attractive than they would have been certainly a couple years ago. Let's pivot, if we could, to talk about the cryptocurrency space. Our guests yesterday were talking a lot about sort of this long-term rotation that we've seen. I know you and I have talked about the strength in Bitcoin really starting to manifest. Talk us through the ETF we're showing here, BITQ. Why is this a potential opportunity here?
Yeah, great question. So again, this space is very volatile. And I mean, 91% down off the highs, that's obvious, right? So this is not for the faint of heart. This is a very volatile area, but very tied to the whole, Bitcoin space. And so to me, I look at Bitcoin, I see an uptrend and I see a recovery and I see very good behavior. And now you're starting to see that come through these stocks. So this happens to be one of many ETFs. I would argue they're all quite similar if you look at all the underlying holdings. But the bottom line is I've drawn a little bit of a base on there and put another green circle on. You can see we're just kind of making price activity where suddenly something has stopped going down. I think I can definitely say to you that by the time something falls 91%, most people have no interest at all, because of course, if you've written it down, your sickness, and no one else wants to talk about it. But when suddenly that's coming to life at the same time, the underlying, in this case, I'll use Bitcoin as the example, is coming to life. I like it. And you can see this is a weekly chart. It smooths out the day to day, but the bottom line is it's grinding higher at this point. And I like that. It looks like good behavior. And I think there's tremendous opportunity, but again, very risky, especially during the day, right? It's a volatile space.
Very much so. And it's interesting, we obviously had filings for new Bitcoin ETFs here in the US. I know in Canada, there are some Bitcoin ETFs to be spoken of. In the US, it's sort of a missed opportunity for now. Could be some upside if and when that actually plays out. We only have a minute left, but I'd love to talk a little bit about markets outside the US for the US-focused viewers watching today. $VEU is a basically a world ex-US ETF. Is this an encouraging sign or not, and why?
Well, 2 weeks ago, that circle, I circled it green. Now I've changed it to red. And the reason is because that's a breakout, right? So first off, again, back to the argument that the US is the only story, 7 stocks are the only story. Well, that proves that wrong because this is ex-US. And so that was breaking out. Now, again, the very next week we broke back down. So to me, it's a failed breakout at this point. But at the same time, it's something we need to keep an eye on, right? There's still higher highs, there's still higher lows there. And I think to me, it does speak to the constructive action globally that I think we've been continuing to see build, right? There was a lot of strength in Europe at the beginning. Again, a lot of the markets in Asia have been pretty weak here, but it doesn't take a whole lot to suddenly have buyers start to come in because people have been negative. And that's exactly what I think we were starting to see. Now it's going to need to reprove itself and kind of come back above that line. And if it does, well, I think that's just another game on point for risk-taking overall.
David, it's been such a pleasure to get to know you, follow you and your work over time, and I'm super excited to share some of that expertise with all of our viewers. Thanks so much for coming on the show. I hope we can do it again soon. In the meantime, be well and stay safe up there in the Toronto area, all right?
Thanks very much. I appreciate the invite.
That's David Cox. David's a portfolio manager at Raymond James. He's up in the Toronto, Ontario area. And what's interesting about David, he's a really smart guy, and what I love about someone like David, he shows these very simple rotations, simple breakouts and breakdowns, There is so much intellectual rigor when you talk to David. What I have, he's a smart guy with a lot of understanding deeply behind a lot of these charts that he's saying. But it's a great reminder to me to just keep it simple, keep it straightforward, focus on the evidence that the market is providing back to us. Some really interesting charts, and again, telling the story of how the market has been incredibly resilient. Get nervous when that resilience starts to fade. I'm not seeing those signs of fading just yet. Great take there, as always, from David Cox at Raymond James. We need to wrap this show, folks, and go right to the 3 in 3, 3 charts in 3 minutes that tell the story of this market. So the first chart, we're looking at the S&P 500, a little longer term. The charts that David Cox was sharing, some really good weekly charts, and it was inspiring me to think, all right, what is the bigger picture here of the S&P? Let's take a step back from the monitor and just think about the overall trends. When you do that, when you look at the S&P for the last 3 years, when you think about the move, the experience we've had from the low in March of 2020 to the high at the end of 2021, the low in the fourth quarter of 2022 to where we're at now, just clear trends to the upside and the downside. It's a pretty significant drawdown, around 27, 28% or so, depending on how you measure it, from the peak at the beginning of 2022 to the October low. But from there, we've now retraced over 61.8%. And what's interesting when I look at the chart on this time frame and think about the bigger picture, how meaningful it might have been when we get above 4,300. This pullback that we've seen recently to sort of that 43.10, 43.25 level, I think could be really meaningful. As long as that holds, again, the framework that I'm seeing here tells me we've rotated above and now we're in an uptrend until proven otherwise. We break that level, and I think you have to put a question mark on it and start to think about a different state. But as a trend follower, I'm following the trend. The trend for now, higher highs, higher lows, still going to the upside. Chart number 2, the TLT. We're looking at the long bond ETF, essentially. Bond prices. This isn't looking at yields. So sort of like the 10-year yield flipped upside down is generally kind of what we're looking at here. We're looking at the last couple of years. Look at how bond prices, of course, have been going lower through this course here. And then you can see in 2023, it's been basing. It's been a sideways pattern. Today, the TLT was down about 1.8%, one of the worst days that we've seen in quite some time. But that drop still is just on the midpoint of this range that we've been in. What's interesting is this is a market that has been consolidating. Look at the RSI. It's rarely gotten much above 60. It's rarely gotten much above 30. Today with the drop, it's just flipping below the 50 level, but we're still sort of in that neutral range. The poll question about a sideways market, the TLT was the chart I had in mind actually when I was putting that question together, because it makes me think that this is where we're at. Now, at some point that is going to change. And I think what's great about a chart like this is we break above the upper boundary, we break below the lower boundary. That's when you need to really recognize that something is different. For now, still in the middle of that trend. All right, in chart number 3, UAL, United Airlines. Now, this is a candle chart looking at the last 2 months. Look at this 3-bar pattern that we've seen over here. Does this look familiar? Do you know what it is? This is maybe digging into the candlestick analysis deep history in your brain. I know for me, it was tough for me to come up with the name of this one because you don't see it that often. This is called an evening star candle. It looks a little bit like an abandoned baby candle, which would be a little different. This one's called an evening star. It's a 3-bar candle pattern. Here's how it plays out. You have a big up candle. You have a doji candle where the open and close are almost identical, kind of at the upper end of this range. And then you have a big down candle. So it's kind of like a bearish engulfing pattern, right? If you ignore that middle candle, you'd have a big up day and a big down day, classic bearish engulfing pattern. But if you have this little doji right in the middle between the two, right in the upper end of the range, it's called an evening star. If you would see this at a bottom and have it inverted, it would be called a morning star candle pattern. So just like a bearish engulfing pattern or a dark cloud cover, another bearish configuration suggesting short-term weakness over strength. So interesting that we're seeing this in UAL. I think that airline space within industrials has been actually an emerging area of strength, starting to do pretty good as some of the other names like Alaska and AAL and others having a bit of a bounce here, but a bearish 3-bar candle pattern called the evening star candle on UAL. Folks, that's a wrap for this show. I want to thank you so much for joining us every weekday after the close for the final bar. A special thank you to David Cox of Raymond James, joining us from Ontario, sharing his wisdom with us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll see you tomorrow.